to share some recommendations on pricing for international growth with the management at Brompton. I hope that these thoughts can help you shape your strategy to conquer the world. Brompton has a long history of profitable growth, and we really want to position to continue in the uncertain post-Brexit macro environment. We're exposed to a number of risks, including devaluation-driven inflation as the pound has fallen against peer currencies, and also the possibility of austerity that the UK has had in a history of Tory governments implementing those sorts of policies could be demand destructive. But the headline recommendation, we think that Brompton should maintain pricing in line with inflation as much as possible and try to make lemonade by leaning into the Forex tailwind that sterling depreciation gives you in order to grow export share and diversify some of those UK demand risks. Average selling price for exports has historically been below that for the UK in all but 1 year. So I think that we can start to close the ASP splits as new SKUs add value and the value proposition keeps pace with price increases, which might have to move a little faster in foreign markets. And we might have some room for that based on pound depreciation, although it's a little unclear how much of a relationship there's been between Forex and actual growth in a given market in the past. So take that with some salt. And we're not trying to make our business strategy off of macro here, but it's something to consider. So expanding margins for exports is always going to be a goal, especially with supply chain, fuel price headwind. So we need to think about going more direct to consumer. As of the date of this case, early 2021, there's some worries about inflation, which of course have proved to be true with our 2023 hindsight. And we need to mitigate those risks because along with the direct to consumer channel mix shift strategy, there's some working capital implications there that need to be managed. So first, I want to talk about the competitive landscape. Management is well aware. Brompton is a lifestyle brand, a little over a quarter of market share. And it's unlike any of the others. There's a really vibrant online communities, subreddits, meetups all over the world, and very active groups that are managed and stewarded a bit by Brompton, but are really organic. And as you can see from just this one selected Reddit comment at the top, I thought this encapsulated a couple of themes that I saw as I was perusing all of these online spaces to try to understand what the brand means to consumers. The nearest competitor, the biggest by share is Dahan. I'm not sure how to say that. Good, but not a Brompton, right? The Brompton really is the standard. And there's also this dynamic where Bromptons maintain their resale value. There's less cannibalization. People aren't really willing to sell them for a big discount to retail. This user talks about that and also about eventually upgrading to a Brompton, right? So it encapsulates this idea that some of these more entry-level brands, they might be almost like an on-ramp to a Brompton as people get into just like a folding cycle is for them, right? This works with my lifestyle. This adds value to me. And then there's this aspiration to upgrade to the aspirational brand. Now, of course, that's not going to be everyone, but this is definitely a source of moat in a fragmented environment. So in terms of the strategy or how to leverage these strengths and maintain our kind of premium position, Brompton has been really trying to create an omni-channel consistent UX across e-com owned stores, which you see here, which have been growing as a share or sale, really are about totally reinventing the experience of a bicycle store. If you hear Butler-Adams, the CEO, talk about what he's trying to do with these, then a lot of that is actually about gender parity, right? They really try to have 50-50 in the workforce, right? And making it a welcoming space to everyone, right? Bike stores can be kind of cluttered and very technical, a very doodly workforce. And then the other thing that they're doing to try to do customer development is having this mobile first rent a Brompton experience and also a subscription based leasing program. That's not about creating ARR or whatever. It's actually a loss leader, but it's about proving out the value proposition to new consumer. They don't disclose attach rates from that program, but management seems bullish on it a couple of years in that this is in fact developing the future customer base. So the other big strategic context here is that we have been growing great guns, and the next big chapter of that is this 100 million factory that's going to be splitting the difference between London and the Eurostores in a wetland on stilts, super sustainable flagship for the brand, but it's going to cost a lot. Factory tours are a big thing already. And of course, you can imagine this will make that even more attractive and a bigger part of evangelizing the brand. And, hopefully just from a financial perspective, they can continue to execute against some of the digital transformation initiatives that they've spoken about, Internet of Things capabilities, being able to squeeze out some gross margin efficiencies despite input inflation, right? That's labor and parts. I just want to underline that this company is a compounder, and they have compounded book value over the long term. And really we're seeing kind of the hockey stick inflect here, COVID, of course, being a driver of that. But to hear Butler-Adams talk about it took a long time to get here. It's not growth hacking or chasing growth in some kind of breakneck or unprofitable way. This is the result of decades of hard work. We can look at the margin structure over almost a decade since 2015. Notice that they are cash generative in all but 2 years. 2016 was when they built their new factory. and 2022, you can see there's some gross margin compression into these sort of macro headwinds, the pound depreciation. So only 25% of the parts are imported of it. It's really just labor and cost inflation domestically for the most part. But it's really coming from OpEx, right? There's this real ramp of sort of investing through the income statement here, where you can see it's not that the earnings quality has gone down, right? EBITDA, net, and free cash flow margins have gone down in line. So this, how they've converted EBITDA into free cash flow historically. Now there's a bit of a divergence here, and that has partly to do with inventory build ahead of inflation. That's strategic to a degree. So that's a lot of working capital. There's also, a CapEx ramp, right, which depreciation takes time to catch up with. If we look at that OpEx, R&D margin has risen, right? So that's investing through the income statement. That's another big piece of the OpEx growth, and that's the R&D ramp. They put in a couple of new SKUs that were R&D intensive, the titanium electric models in 2022. So that should be a one-off. And price has not been a huge driver of growth. We don't know the breakdown for 2023 yet, but price and mix have been, on average 8% of the really breakneck growth. And as a share of growth, right, we can see that price does not particularly correlate with a decreased growth rate. I mean, you can maybe make that argument in 2017 to 18, where pricing was a bit more. In 17, then growth decelerated a bit, but that trend breaks in 2020. Whether that's structural post-COVID differences in demand, we're not really sure, but demand does not appear particularly elastic, or at least there is white space to grow without chasing share gains through aggressive pricing. So, if we think about elasticity, and I think this is kind of how Will Butler-Adams thinks about it, in the short term, there's elasticity. There's somebody might be thinking about a cheaper folding bike, or they might be like, well, I don't really want a folding bike at all. But as cities become, more and more bike friendly, as bikes become more and more a given and less of a discretionary recreational kind of purchase, and the culture shifts to see them that way, we might even come to a point where we think about bikes more like a car. And, if you look at some of these Europeans, we can say, if you squint, what that future looks like, where it's just a given. It's not some guys in spandex thing, right? It's just everybody commutes on these things, and it's viewed as an investment. It's maybe less like a car than like a smartphone, which Will has also talked about. Who would have thought in 2007 that this fancy new iPhone doodad would be an absolute necessity for everyone, and they would pay $1,000 for it, no problem. So as we're trying to diversify into some of these geographies that are maybe a little further ahead of this adoption curve and also have the disposable income, that's really Europe for now. And of course, the rest of the world, including the US and Asia, are maybe a little bit further out in terms of the infrastructure, and in Asia's case, in terms of the disposable income. So we're really thinking about Europe mainly, but every year except 2018, bikes haven't sold for as much internationally. Export share of unit sales has been pretty consistent at high 70s, 70 to 80%. Europe is the priority geography right now. And to a degree, that is hedging some of the inflation risks in the UK, right? The UK, at the time this case was written, we were here, hadn't inflected up yet, but there were worries and they came true. And now it's coming down, but it's coming down slower than other peer markets. And there are things about the UK economy with import dependence that maybe make it more inflation prone in the future as well. Even though Brompton doesn't import a lot of parts, they do take some gross margin compression. There's an inflationary environment because they're already priced at the top of the line, and they can't really pass all of that on to consumers. They're also a pretty ESG focused company. They're not going to try to maintain margins on the backs of their workforce. So cost per employee has come up. The other thing about inflation is that there's this inventory build where you can see it's outpaced sales growth. It's a percentage of sales. It's grown. And that's going to have working capital implications for they've had to actually finance it. They had to take on a bank loan or on their revolving credit facility in a high interest rate environment. There's a cost to that. So we have to think about how to manage those things. And hopefully some of the new factories squeezing out some efficiencies can help with that, as can perhaps better data on e-commerce and really trying to forecast demand more tightly, but wanting to hold this cushion against geopolitical risk as well. Taiwan is a big exporter of bike parts, and management has talked a lot about wanting to diversify away from that with geopolitical risk and all of those things. And looking at pound euro here, and I'm committing chart crime by chopping off this axis so that you can see it a little bit better because these are small movements. But even with the pound depreciation, right? This is from the international buyer's perspective. Like, how many pounds does your currency buy? Grain bar is higher, then you can buy more pounds and hence more Bromptons. Pound devalues here, and actually Europe's growth rate decelerates in line with the overall world. It then outpaces it in the next year. The pound stays weak, right? Maybe that takes a while to feed through inventories or something. They start to order a little bit more. So maybe you can see it here, 2018 to 19, that pound weakness reducing European growth a little bit. Pound strengthens and it goes down that same year. And these are averages, right? It's average of April 1st to March 31st when their fiscal year ends. And it weakens again. And okay, Europe does catch up a bit. And here though, it strengthened quite a bit. This is not all of 2022. Remember, this is just to March. And we don't have data for 2023 yet. They haven't broken out Europe sales for that. So we may see some impact from the whole trust dumpster fire that happened. But we'll see. If there's something, it's not going to be huge, I don't think. Maybe that's arguable, but it makes sense to lean into Europe
regardless of the four active. We're not trying to make a macro call here, but Europe's infrastructure is ahead and you've got spending power.